Now, Zimbabwe has launched a new gold-backed currency, replacing its current currency. The new currency, called ZiG, short for Zimbabwe Gold, is mainly aimed at tackling the Southern African nation's high inflation levels. Development economist Prosper Chitambara joins us with more analysis as we put the currency under the spotlight. Prosper, always a pleasure and a good afternoon to you.
Thank you so much. Good afternoon to you too.
All right, Prosper, keen to get your thoughts here. This development has been met with quite a bit of trepidation, I think, from many. But maybe let's talk about the existing currency within Zimbabwe that has given rise to the decision for this new currency to be launched.
Yes, so the existing currency has basically been decimated by years of chronic high inflation, and as a result, economic agents have lost confidence in the Zimbabwe dollar. So the introduction of this Zimbabwe Gold is really an attempt for a fresh start in terms of kickstarting our macroeconomic stabilization agenda going forward. So it's ultimately an inflationary problem that has resulted in the local currency losing value and economic agents beginning to substitute the local currency for the USD, the dollarization that we've seen actually. It's a direct result of the chronic high inflation, which has been bedeviling our economy since 2019.
And this Zimbabwe Gold is backed by foreign currencies, by gold, as well as other precious minerals. Let's just help us understand how this is meant to protect its value in the future.
So the idea is that the central bank has linked the reserve money of Zimbabwe Gold to the stocks of reserves, gold and foreign exchange reserves that we actually have. So what it then implies is that any increase in Zim Gold supply, money supply, has to be matched by an increase in the amount of reserves that we actually have, whether gold or US dollars. And the beautiful thing is that Zimbabwe is one of the biggest producers of gold. So it's going to be easy, I think, for us to be able to increase our gold reserves. And with the trends that we've been seeing, the price trends of gold, the increase in the price of gold over the past few weeks, I think that augurs well, obviously, for the new currency. But ultimately, the monetary policy, in my view, must then be complemented by other supportive fiscal and even sectoral policies. We need to align everything in line with the monetary policy stance of monetary tightness.
I also want to talk about, the gold reserves that we currently do see in place that the government does have, Prosper, versus the amount of money that might move through the Zimbabwean economy here. Are we seeing an accurate matching of the two, which I think is necessary in ensuring that the currency can hold?
I think from what we've heard from the central bank, there seems to be a match, even in terms of the initial exchange rate determination. Of course, there's always room to improve, because ideally a country like Zimbabwe would require about 6 months import cover. That's in line with the SADC macroeconomic convergence criteria. So 6 months import cover for Zimbabwe gives us around 4.2 billion US dollars. But I'm thinking that with time, I think we should be able to build our reserves and hence ensure greater levels of confidence in the Zimbabwe gold.
I'm also keen just to then speak about all the other fundamentals that ensure that a currency can hold. A big one is the issue of, inflation and interest rates here and all the efforts that the central bank has put into place. But also, if we look at the inflation picture even around the world, tense right now with many emerging markets like Zimbabwe trying to defend their currencies against a differential with the dollar that might lead to the kinds of hyperinflation that we are trying to avoid here. And so I'm wondering that as we try to put this Zim Gold into play here, how do we also manage those very complex issues, Prosper?
Yes, you're actually right. There are a lot of complex, especially external factors that come into play. But I maybe that the bulk of the challenges that we have been facing, especially around chronic high inflation as an economy are factors that we can directly control. Factors around, for example, the unsustainable growth in money supply. So given the right amount of fiscal and monetary discipline, it's easier for us to put a check on unsustainable growth in money supply, and also trying to ensure that government lives within its means. The issue of public spending, of course, this year is going to be a challenge owing to the cyclone-induced drought, which has meant that our agricultural production this year is much diminished. So there's going to be a lot of pressure, I think, on commodity prices, food prices, and that would actually scupper our inflation target. Central Bank is targeting an annual inflation rate of between 2% and 5% by year end. My view is that it's overly optimistic, and given both the internal and external pressures, we may not be able to achieve that 2 to 5% inflation target by year end. But earlier on today, I was actually on a panel with the new central bank governor. I get a sense that is very well-meaning, and I think if he's supported, especially from the central government side of things, I think we can actually be able to arrest the challenges of instability and the runaway depreciation of the local currency that we've witnessed.
Prosper, let's talk about also the 21 days that people have been given, businesses, or to convert their old cash into this new money here, and the issue of confidence for households and even for businesses here. 21 days does seem like a rather a quick amount of time, like a very short period here. Let's talk about that and the reality of us seeing that come to fruition based on, like I'm saying, the confidence issue there.
The confidence issue is a major problem. And we've already seen that a lot of service providers are now actually refusing to accept the old Zimbabwe dollar notes. So that's creating a challenge in the sense that people need physical cash to pay for the commuter omnibuses to go to work. So that's actually a major challenge. So it means most people have had to resort to using the United States dollars to be able to pay for things such as paying for your commuter omnibus fare, or even in the retail outlets. A lot of the retail outlets, especially the informal retail outlets, because for a long time they've not been accepting the local currency. So it creates a lot of challenges, definitely, around issues of confidence. But I think once we begin to build a track record of following up on what the MPS is intending to do, I think that's going to result in the restoration of confidence. But it takes a bit of time. It's not just an overnight event. It's a process actually that takes time. And it's a process that's also dependent on the capacity of the central bank and government to be able to implement these policies, monetary policies and fiscal policies consistently and complement each other.
Well, Prosper, it's been a pleasure hearing from you today, and I hope we can catch up soon just to track the progress of all of it. That was development economist Prosper Chitambara.